Good afternoon. It is the 27th of May, 2026. It's been a while. My name is Adishin Naidu. I'm from the Global Markets Retail Trading Desk. I'm joined with Tom Gale, Executive Global Markets. This is the Market Pulse. How are you doing, Tom?
I'm good, thank you, Eddie. It's nice to be back. We've had a couple of weeks off, I seem
Well,
to recall.
yeah, we had a few weeks off. And I somehow feel that sometimes every time we come back after having a bit of a long break, there's just so much to cover. So there's a lot going on. I think everyone's exhausted with the war. That face says it all. But hopefully you could give the audience some direction or some help here in these times.
Well, this gentleman here looks how I feel, I must say. Um, like you rightly say, I think we've all had enough of this. Look, I think the important thing to bear in mind here right now is that he will have had enough because he has quite frankly miscalculated. It wasn't quite the precision operation that he enjoyed in Venezuela, having lifted the president from that country, and he had probably slightly naively expected something similar in Iran. But the problem that we now sit with more than 2 months into the conflict, and a conflict that, remember, he and his secretary, so-called Secretary of War, had telegraphed was a conflict that would last a month or less. We're now sitting globally with dangerously low levels of energy stockpiles, and that's not me making that claim. That is the claim of, for example, the Global International Energy Agency. The graphic on the left here is showing you a snapshot of US stockpiles of gasoline and diesel and other energy products in the orange line. So in the orange line, you can see that we're currently sitting with stockpiles way below the 5-year, typically way below the 5-year average. And not only are physical inventories low as the US heads into their summer driving season, where they hit the roads and there's big gas guzzling SUVs of theirs, but with prices at the pumps so high, Donald Trump's ratings are historically low. So that's the graphic at the bottom there, as measured by The Economist. And most of you should be able to get this chart, see this chart for yourself on the Economist website. It's there for free access. So go take a look. It's interesting. That is the pressure coming to bear on President Trump as the US heads towards midterm elections in November, and the possibility of losing both chambers of their parliament. Then it's curious, Addy, that the S&P's been on its charge.
That is curious because locally it's been the other direction.
Yeah, we'll come on to that. But I think to a large extent, and there'll be plenty in your audience who called this right, and I hope more so than not. But I think there are those of us who are somewhat surprised just how resilient US equities have been, and the S&P now up more than 18% from the lows and making new record highs. So given all that, I mean, there is certainly a wealth effect which will keep some voters staunchly Republican, but not all of them, and it is certainly not the case that all Americans sit with a tidy 401k plan or indeed their own private share portfolio. I'm not going to talk to this today and the reasons for it, but maybe just in passing to mention it was certainly a very strong earnings season in the first quarter. Those earnings have been coming out since April. So a really strong performance from earnings, clearly weathering the storm, not only from the conflict, but actually from last year's tariffs as well, it must be said. And then, of course, one of your favorite topics, Addy, which is artificial intelligence. Those stocks have done well, have they not?
Yeah, so I mean, AI has done very well. I mean, Nvidia's is also unbelievable. So and we can see continuous improvements with it. So it's quite insane that continues to drive this US market. I mean, those tech stocks. I mean, what did they say? The Mag 7 is just unbelievable at the moment.
Yes, well, look away from the Magnificent Seven, specifically those AI stocks and the AI index that is being tracked by Standard Bank product in the auto call that we put together last year. Those in your audience who sit with that will be sitting pretty at the moment.
Yeah, at the moment, and provided, as said, that still has to be held to maturity.
It does, but there will be observation dates as we talked about previously, which so far will be looking good.
Yeah,
Okay.
100%.
So as I say, we're not here to talk about the S&P today. It's more just to reflect upon the local landscape. And as you rightly point out, it hasn't quite been the same performance from the JSE. And here again, perhaps we are somewhat, disappointed because we remain very positive on the JSE, the valuation and the prospects for our universe. You can see the graphic on the left shows how the JSE has performed. We're sitting hovering just above our lows, so no signs of record levels anytime soon. The middle graphic perhaps explains it a little bit. The orange line are the miners, which are typically precious metals miners, so they've kind of really held back, really dragged on the all share, and then the blue line has been the blue line is our retailers sector, which have just struggled given the consumer pinch right now, and you can see the sorry performance of some of those at the bottom of the worst performers on the right. So I think Adi, this is just really overall, I don't think any of this comes as a huge surprise given we live this, but there still is good value on the JSE.
And I mean, just keeping this graph on the screen and looking at, as I said, number one, Sasol. I mean, it's a no-brainer, but it comes back to, I think we've had a pulse a couple months ago where we actually had a pulse where gold was at one point was trading at 5,500, and our market was flying because of the miners. And when this conflict started, I recall asking you a very interesting question around, conflict is on, why isn't gold being, used as a safe haven again? And I mean, it's clear in what you're illustrating here that, it's not just the safe haven. You got to look at what's actually happening in this market, look at what actually is driving this market, what's the reason, and you can see the JSE being, actually feeling the pressure.
Well, yeah, and I think we've touched upon why the reasons why gold struggles to perform in this environment over the years and over the centuries. Indeed, gold has been a store of value in the face of inflation, also in times of distress and geopolitical tension. But it also does rely on yields being low because it is a zero yielding asset. Gold, it doesn't pay a coupon, nor does it pay a dividend. So it tends to do well. It did do well pre-conflict because so much of the world was in a cutting cycle. And indeed, the US was expected to cut rates at some point too. Well, a lot of that is reversed in the face of inflation, and that's been a headwind. So you're right to point this out. I want to just mention Sasol because you talk to that. What a performer! It's true for Sasol as it is for the coal miners that this crisis has to some extent landed in their laps. But what I would say where Sasol is concerned is that our analyst has been very positive on Sasol for a while, and he frames this as a self-help story, not just one that is utterly serendipitous, given what energy prices have done. And in fact, our analyst remains one of only two on the street that still has a buy rating on Sasol. So a lot of the crowd have decided it's it's moved a lot and it deserves a downgrade. Well, our analyst remains constructive. You're going to get buffeted by the oil price, of course, oil price volatility, but it is one that he feels with some conviction is worth still owning. It's still incredibly cheap.
Well, that's still a
most metrics.
question by most retail clients. I have in conversations in passing that meet me, and I'm sure you have the same, because you are quite, as I said, a big follower. You have a big following with our base now, but I mean, that is a question that comes up, like, is it still worth a buy, or has it run? So that wraps it up quite nicely.
Yeah, and in fact, maybe one piece of advice here is for those in your audience who hold our oil ETN, which is JSE listed. That's SB Oil, so Sierra Bravo Oil, Standard Bank Oil. That one, if you're concerned that oil has run too hard, that's one that you'd think about selling, but now sit long rather Sasol, which has some core operational leverage. And remember that Sasol isn't just a producer of synthetic fuel; it also produces petrochemicals and polyethylene, so plastics and so on, and that is a commodity that is in short supply, so it will continue to benefit from that global crisis. So plenty to think about there. We all will feel this particular slide. We don't need to read the big writing here. Look, things could be worse, I would say, and that's.
Did you just say worse?
Well, that's little consolation, really. But the fuel levy has been suspended. We'll all maybe all recall, and without the fuel levy having been suspended, this would read worse. I think the thing to bear in mind is that from next month, that is June, the fuel levy will start to be reintroduced. It's very difficult for this government in the tight fiscal space that it's in to remove the fuel levy, in perpetuity. So I think even if oil normalizes, pulls lower, our fuel price will probably be a bit sticky, and that does naturally impact our inflation trajectory. So the graphic on the left shows then what impact high fuel prices had on inflation. I don't want to be the bearer of bad news here, Adi, but our weather and climate analyst Penny Byrne has also warned that weather and climate patterns and ocean surface temperature patterns do indicate that we're heading towards an El Nino outcome this summer, which typically leads to very dry and hot conditions, potentially drought conditions, and that could impact the harvest that we have, the crop harvest that we have coming up. So there could be further inflationary pressures ahead. It's of little consolation, therefore, for now, that oil prices appear to be moderating for all the reasons that I've given. Now, we might expect that we see for the oil price itself, Brent crude, a pullback. We've already had a pullback to around $97 a barrel from above 110. It's possible on the announcement of a deal in the Middle East that oil could drop to 88. We see that as kind of almost next stop on the chart on the way down. But this will not be smooth. This is not a straight line to that. And in fact, volatility will continue, and it's possible that we're going to get pops in the oil price too. And given all the stickiness that I've just talked to in the previous slide, we won't. We're going to sit with a problem that will remain a legacy problem for the time being. The graphic on the right will just show what the market projects for the oil price for the next few years. And I don't want to spend time on this particular chart for now, but I think the one takeaway is to say that before conflict, oil, an undisturbed oil price was kind of $50 and probably heading through the curve even lower. Well, everything remains elevated. The current forward curve of Brent crude remains elevated, and market expectations in the blue line also remain elevated. So it's going to take a little while for things to normalize. We've felt all of this in inflation. We've started to see inflation tick higher. 4% was the headline reading for April, and expectations as measured by the market, that is to say linkers and an asset class here that would isolate what the market is expecting inflation to look like, is above 4% in the medium term. So this crisis could have done some lasting damage. Now, why does this matter in particular? Well, because the Reserve Bank, Adi, had only recently lowered its inflation target to 3%, and a critical component of lowering and getting to a 3% inflation is anchoring expectations, market expectations, and surveyed expectations. And so really on balance, and it really will come down to the wire tomorrow, it's likely to be a split vote at the Monetary Policy Committee meeting, and it could be as tight as 3 votes to 2. But we suspect that there will be a hike. The Reserve Bank needs to defend its credibility, having just revised its inflation target lower to 3% just before the outbreak of this crisis. And market readings, I've highlighted in red on the graphic on the left of what's priced for tomorrow's meeting. So if it's 22.2 basis points, that is 0.222%. That indicates that it's almost fully priced for a 25 basis points or 0.25% hike tomorrow.
No, I mean that's you just showed the graph of the fuel and where we are in terms of fuel levy and the fuel prices in terms of inflation, and I mean, as you said, as an SA citizen, it is really becoming tough. And I mean, this rate hike actually. We were almost, I thought at some point when we were doing this, when we started these pulses, as I said, we were almost thinking that we were going into a rate cutting cycle, and now we feel almost like we're going backwards again. I mean, can we expect more rate hikes this year?
Yeah, very good question, and really the $1 million question. And as if you follow the column down from the highlighted, the red highlight 22.2. What that column is telling you is that the market is pricing further hikes through the cycle. This is possible. There are some distortions in here, and we cannot take this as read. The problem really that is entrenched for South Africa over the last few years, the last 10 to 15 years, has been low growth, and we're sitting. Still, despite our positivity for the economy here, with forecasts of GDP growth that does not even keep up with inflation. And so in the end, eventually, the Reserve Bank will have to resume rate cuts. For the time being, they want to defend the new inflation target. Inflation is a destroyer of value for the poor as well as for the rich. So I think that the path could look something like the following, that the Reserve Bank hikes tomorrow, maybe not tomorrow. If they don't tomorrow, maybe they do at the next meeting. And thereafter, if this crisis in the Middle East resolves and energy prices start to drop and the Reserve Bank becomes more comfortable with the how benign are the second round impacts of energy inflation, then they can resume their cutting cycle. And our economist, Elna Moolman, points out that the path becomes a little friendlier for the Reserve Bank going forward, because we start cycling off a higher base in previous years or last year, and actually, Elna, forecasts that by 2027 we will be back inside the 3% inflation target. So, I suppose my message here, Adi, is to everyone: hang in there, hang in there. I'm not going to dwell on this particular slide today, but I do just want to talk to you and your audience and those of you who are concerned about platinum group metal prices and to some extent the gold price. Have they lost their mojo? I guess the short answer is yes, they have, haven't they? Their prices have struggled. But once again, we remain constructive on the outlook, especially for PGMs. In fact, our platinum analyst was in London last week for the yearly gathering of platinum analysts, and although there was some caution there, he did come back with the message that he feels committed to his call for platinum and palladium and rhodium prices to recover. And you'll be familiar with some of these narratives. The AI tailwind. You need platinum actually for diesel. For the catalysts in diesel generators to power the data centers, and actually you need platinum and rhodium bushings for the specialized e-glass panel boards. We don't need to go into the detail of what this is, but you understand that it's the high technology that's required to power these super fast processors. And ruthenium, another platinum group metal for data storage. So yes, platinum has been struggling. But we firmly believe that platinum will recover, which in time will be good news. Another piece of good news for the Rand. And the Rand is benefiting right now from the idea that we're going to hike rates tomorrow. So that defends our high real rate. But also, there's still a good reform story here in South Africa. Please, let's not lose sight of the big picture. I just want to talk to this slide briefly because this is South African borrowing costs, government borrowing costs, and you can see circled in red that our borrowing costs have gone up a little bit during this crisis, but they're still way below where we were during the election and the formation of the Government of National Unity a couple of years ago, and borrowing costs are also lower than where they were a few years ago when the Russia-Ukraine crisis caused a spike in energy prices. So there's a story here in South Africa that is firmly intact, and it was one that was acknowledged by credit rating agency Moody's a few days ago. They have upgraded their outlook on South Africa to positive, and this speaks to fiscal consolidation and the reform program. So I want to leave you and your audience with that abiding message, which is that the outlook, although there are challenges and headwinds, remains broadly constructive.
It's not all doom and gloom, eh?
And you're going to talk to this slide, Adi. So I'm going to hand over to you.
I mean, in previous pulses, the audience knows that we normally speak to, and I mean, you've actually done a fantastic job on a number of our structured products that we offer, structured notes to our retail clients. We have monthly structures that we still have on offer, but one that's quite interesting now is the MSCI World, Digital Plus. It's a little note that we kind of looked at and said that it's a requirement. I think it's a need and fills a void right now with what's going on, given the uncertainty and as you said, markets across multiple facets. The developed markets are up and down regardless. So we looked at this product specifically looks at the large to mid cap across 23 developed countries or 23 developed markets in the MSCI World. It's a decrement index, so meaning it goes down 4.5% on the performance, but it gives the reason we've used that index and it'll settle in the MSCI World is because it gives an upside return. So basically this product, for the audience listening, is a fully capital protected product in ZAR, so it's 100% capital protection. It's a 3.5-year termed product, and basically it pays a 37% coupon whether the index that it's tracking is flat or positive over 3.5 years. So if you hold this specific structured note in your portfolio for the full 3.5-year term and the index is flat or positive, you would get a 37% real return on your investment. Now, basically, what gives you as well is if the index is more than 37%, okay, you would get the full participation. So the index is 50% up, you'd get 50% return. If the index is 20% up, you'd get 37% return. So it's quite a great investment, or a capital protected little note to put into your portfolio. It gives you a currency hedge because it actually is a world tracker. So it's tracking, it gives you offshore exposure in dollars, but you're not utilizing your single discretionary allowance. So you're basically investing in rands with a currency hedge in dollars and fully exposed to MSCI World. So it's a great little product. I'd urge clients to give our contact center a call as per normal. If you log on to online share trading, you will see the little note under your special announcements where you can click on it, have a read through the brochure. You would have received a few mails. This product is closing on the 17th of June. So a little over 2 weeks left to subscribe to this product. And as I said, it's 3.5-year term. So it's a great little product to have in your portfolio, given what's going on. And I mean, given the outlook that Mr. Gale has given today. So thank you so much. And Tom, thank you as well for your insights. It's great to catch up. And let's touch base again next week.